I know I haven't posted the recording from last time yet, so I will definitely get to that here. You know, while we're here together, and I know I've already started the recording, but I've been wanting to check one thing, and I want to do that. So let me look at, I don't know why I'm going about it this way. This is probably the slower way, but I want to look at the syllabus real quick. Because I've been telling you all to take your exam May 1st, and I want to make sure that I haven't squeezed you too much there. Yeah, okay, that's fine. For some reason, sometimes when I go for a run, I start thinking too much about things and I start making things up. I was thinking, wait a minute, isn't the last day class 427? Why am I telling my class May 1st? But now it makes sense. If the last day of class is 420, May 1st is fine. Like I said, I had gone for a jog this afternoon and I started thinking, well, why am I saying 420? I didn't get a chance to look at it until just right now. So, okay, we're good. So May 1st is the day to take the exam. Okay. Okay, good. So let's go ahead and we can close this now. And let's get to the text and let's all take a deep breath while I put the machine into tablet mode. Okay, doesn't look like anything bad happened. And I can put it into full screen. Okay, good. All right, nice. Okay, good, good. And we're going to pick up where we left off with Module 8. And remember, for A1, we're sort of starting at the end of the process. We're going to be talking about, and we've been talking about in Audit 1, the reports that are generated by auditors. And then starting with Audit 2, we'll start getting into the planning aspects and the various performance aspects of the audit as we go forward. So we spent pretty much all of our time, other than a little bit talk about the standards, looking at the structure of the report and what happens if we have to qualify the report, what happens if we have adverse, disclaimer, member, disclaimer, and qualification on the gas side of the chart, qualification and adverse on the other side, on the gap side of the chart. And then we started talking about how we would modify the report accordingly for those situations. I advised you to pretty much memorize the standard report and then know how to alter it for different situations. And then I think we finished up talking about how to deal with emphasis of matter, other matters, etc. So we're going to continue talking about the report, and now we're going to start to get into, in Module 8, what happens if we if we audit comparative financial statements, and what happens if there are different opinions in 2 different years. So first off, let's just sort of give ourselves a little visual here. Let's say we have our 2022 statements. I'm sure you've seen this kind of a presentation. And then we have the 2021 statements right next to those in columnar format. Well, it wouldn't be, the first time that if engagement had a situation where we had, say, an unqualified or unmodified, remember it's unqualified for public companies, unmodified for non-public companies, and then we had to qualify our opinion for, say, 2022. Well, we've got 2 years side by side. The audit report is giving an opinion on both of those years, but the 2 years have different opinions. Now, when we set that up, you start thinking, well, geez, this must be some sort of big deal. And we're going to see that when we write the report, we will simply speak to whatever our qualification is as it relates to whatever year that is affecting the qualification. In this example, 2022. So we say when comparative statements are presented, the auditor should refer to each period for the financial statements are presented in which the audit opinion is expressed. And then we say we can update the report, which means we reaffirm or it can change the original opinion as a result of changed conditions for information coming to the auditor's attention during the engagement. So we say that the auditor may express, just coming down to reporting with different opinions now, the auditor may express a qualified opinion, adverse opinion, disclaimer opinion, or include an emphasis of matter or other matters or explanatory paragraph with respect to one or more financial statements or one or more period, while expressing different opinion on one or more financial statements of another period presented. And that's really what I'm showing you right there. So let's just go ahead and take a look and notice here that we have the opinion and we say we have audited the financial statements in our opinion, except, and notice we audited 20X1 in 2020, 20XO in this example, and except as it affects the company 20X1 financial statements of not capitalizing certain lease obligations. And then we just continue on with the language that you've learned already. We are giving an opinion on the 20X1, 20XO balance sheet, statement of operations, statement of cash flows, etc. And so then when you continue on with that report, notice when we give the basis for our qualified opinion, notice that the call out really is only about things affecting what? Affecting the 20X1 financial statements. So you still use the except for language for your qualification. You say as it relates to 20X1, and then in your basis for the qualified, you just talk about what was bothering you in 20X1. And we don't have to mention anything about 2020 because 2020, we were unqualified in 2020. We continue to be, think that it is fine to be unqualified for 2020, even though we found a problem with the 20X1 statements. All the rest of the paragraphs are exactly as you memorized. Again, I think you're starting to feel how memorizing the standard opinion then helps you tremendously because you just then have to know how to tweak the, for these situations that we're talking about now. I really don't have a flashcard here for you because I don't know what to tell you. It seems like a common sense thing. You just accept it, right? You just remember it. You just write what it was that you were concerned about for whatever year it was, 20X1 in this example. Okay. Okay, good. And they go ahead and they continue on with examples, but I think we don't need to read through all those. We got it now at this point. There should save paper, not keep giving you example after example of something that I think is very clear for you. Okay. Okay, good. Now you come over and let's take a look at updating or changing prior opinions. So what happens here? Well, let's just use our imagination for a minute, okay? Let's say you're doing an audit and you determine that you have to modify the opinion somehow. You have to give them a qualified opinion for some reason. Somehow they didn't follow GAAP, let's say. Let's say it's a GAAP qualification. So you turn to management, you turn to the board of directors and you say, hey, we're going to have to qualify our opinion for this issue. When you walk out of there, do you think the board of directors is very happy with management at that point in time? They're sitting there saying, hey, look, I don't know, you need to fix this, right? So they're going to go and they're going to work hard, and the CEO and the CFO and the controller are going to work the staff day and night to figure out what the problem is. They figure it out and they say, okay, we can correct this. And they go ahead and they correct it. The board of directors probably calls the auditors back up and says, guess what? We fixed it. Meanwhile, it was probably the staff that fixed it. But okay, so we come back we sit down and they show us the evidence that supports the correct adjustments in the financial statements. Can we change our opinion? Sure. Now we can say, hey, last year our opinion was qualified for some reason, but now we've looked and we want to change our opinion on last year's financial statements. And this may even happen, months after we've issued our report. It doesn't have to be all the way into the next year. So when we take a look, we have to then revise our report, or we will revise or update our opinion, okay? And what we will do, we will add an emphasis of matter or other matters paragraph, or if we're talking about non-issuers, if we're talking about issuers, we put an explanatory paragraph following the opinion paragraph. And the paragraph that we add to the report has to provide the following information. And finally, they give me a mnemonic that I can relate to, which is dorks, okay? So you can go ahead and flashcard that. And the mnemonic here is only dorks change their opinion. So you have to give the date of the auditor's previous report, the opinion type previously expressed, it was qualified. It was qualified because of the reason they weren't capitalizing some leases. I don't know. Changes have occurred. They fixed it. They capitalized the leases correctly now. They've given us the evidence to support that presentation of financial statements. And so now our opinion is unmodified, unqualified, as opposed to qualified. That's it. So pretty straightforward. And you just want a flashcard because you probably see some questions where they'll sit there and ask you what kinds of modifications would you have to make. You'd have to put the emphasis of matter, other matters, or if it's a public company, explanatory paragraph that contains those elements. Okay. All right, good. Not too bad. Now let's take a look and see what happens when we have a predecessor auditor. Now let's first understand what the term predecessor auditor means. When we have predecessor auditor, that means that, let's say you audited the last year's financial statements, and let's say I was able to persuade your client to let me audit this year's statement. In that situation, you would be the predecessor auditor because you audited last year. I would be the successor auditor because I'm auditing this year, okay? Now, I come to you and I say, hey, is it okay if I just leave your report next to my report, because we're going to have comparative statements. So your report will cover last year, 2021, let's say. My report will cover 2022. Do you mind if we do that? What do you think, Serena? What are you going to say? Didn't mean to shock you.
Yeah, I think it's okay, right? Because it's a peer, they're supposed to exchange information.
Yeah, it's okay. It's okay, but you're going to ask me for some things. So you're going to say, well, look, John, okay, I'm not too happy that you took you're really in a position to tell you not to use my report, but I am in a position to ask you for some stuff in exchange for that. Okay, and that's what this flashcard is. It's going to talk about what you need to obtain from me. And so you're going to say, hey, I need to see the current period statements so I can read through them. I'm going to compare the statements audited with the current period statements. So you'll probably do some analytical procedural review key accounts to see if there's been some significant changes there. You will obtain a letter of representation from me, and we're continuing this flashcard, basically saying, hey, I'm not aware of any problems with your audit, because think about it, I have 365 days of hindsight. Sometimes some things come to fruition that we didn't know last year, and you will acquire a similar letter from management, okay? And if I give you those things, then yeah, okay, you're gonna go ahead and let me present your report right next to mine, okay? Now, after you do all that, you have the choice to either revise or not revise your original report. So you can use the original report date in any reissue of a previous period, or dual date is used in the event that the predecessor revises the report. Dual date basically means 2 dates. You'll say, well, the date of my report was this, but I'm revising it because I've done these procedures and I've seen some things now that make me want to change. So you would have 2 dates on their dual date the report. Now,
Question, why would the predecessor auditor revise their report?
because they see something that they wanted to add to the report that they didn't.
Okay, but then why would they reissue the report? I was confused about the reissuing business here.
Well, if somebody audited, say, 2021, it's not a big deal for them to, let's say they audited both years. You would be using the word reissue. You're still reissuing your report for the 2 years. So if I audited 2021 and then I came in, same auditor audited 2022, and you saw that report on comparative statements, when you're issuing the report on 2021, that's considered reissuing the report, but you can reissue it unrevised because nothing has changed. But if 12 months later you're sitting there and you're saying, well, something's changed, I didn't see it before. I mean, it's not the best situation to be in, but it happens, then you would be reissuing the report revised and you would dual date. You'd say, as it relates to this matter that I'm now adding to my report, the date of the report is some later date. Well, this is basically saying that same thing. Even though somebody else audited that next year, you still have to go through that process for your report covering the previous year.
I think where I was confused about it is in the case of someone else then taking over the subsequent year, why would the predecessor auditor reissue? That's what I was kind of confused about.
Well, they don't have to. They could tell me here, I'm not going to let you reissue the report. They could do that. They're not required to let me reissue it, but they could.
So is the idea, is it called reissue if they are just allowed to use the report, the successor auditor is allowed to use the predecessor report? Is that what's called a reissue?
When you say use it, okay, you got 2 years of financial statements sitting there.
Right.
I can't write the report to say 2021 and 2022 is okay because I didn't audit 2021.
Right.
So how are we going to get audit coverage over 2021? Well, you're going to reissue your report. You're going to just let it sit there, hang there as it was if it's not revised, or you may want to revise it.
Oh, I see what you're saying. So just the fact that it's no longer 2021 means that the report gets reissued because it's being, okay, that's the thing I didn't understand.
Unissued, revised, or unrevised?
I'm unrevised. Let's say it's fine, but there's a new auditor. That's what I think that's what my confusion was. I don't think I realized that the predecessor auditor would reissue simply because it's a year later.
Well, it's being published in a new document.
Okay, see, that's the thing. That's the nuance I didn't get.
It's a new document because it now contains another year of financial information, right? So
Got it.
whether there's another auditor involved or not, okay? But you don't have to agree to let that report be reissued in another document. You don't have to do that, okay? If you don't do that, and that would probably be the case, that could potentially be the case when there's a successor auditor, because sometimes, feelings are hurt and that kind of thing. And so when that happens, then the successor auditor, okay, should express an opinion on the current period's financial statements only and indicate in other matters or explanatory paragraph if it's an issue or other matters if it's a non-issuer. Then we would basically book report your report. We'd say, well, the financial statements were audited by another auditor. By the way, and flashcard these things, and flashcard within the flashcard here, right here, flashcard that the predecessor auditor should not be named unless I acquired your practice, okay? But then getting back to our bigger flashcard here, I would say the type of opinion that was expressed, whatever it was, unmodified, qualified, if there were any modifications, the reasons for those, the nature of any emphasis of matter, and the date of the predecessor auditor's report. So if you don't let me reissue, then I'm going to add emphasis of matter, other matters, if it's a public company, explanatory paragraph, basically summarizing what was in your report. Okay, so you can
Okay.
present it. We'll see both reports there. You may revise or you may not revise, or it will not be presented, not reissued. In fact, I think it's better, it's good if we just say not presented. Okay, and if that's the case, then the onus falls on the successor to summarize your report. Okay.
Thank you.
Okay, good. Yeah. Okay, good. No, that's good to make sure we're clarifying. I think it's worth the time to understand it now, because if you're not clear on something now, then later you try to get it and you've lost some momentum, right? So, okay, good. All right, let's take a look at the what happens when the prior period statements are not, and let's just jump down here. I don't know why they say prior period statements are, I don't think we need that there. Okay, let's just look right here. Prior period statements compiled or reviewed. Okay, and so let's just take a look at that. Let's just draw a little picture of that. So it's 2022, 2021, and let's say 2022 was audited, but let's say 2021 was, say, only reviewed or compiled. Now, review and compilation have lower levels of assurance, okay, less assurance. In fact, in the case of a compilation, there's no assurance. And guys, my pen is, of course, dying on me here. I don't know, maybe Microsoft doesn't expect that people would use this pen as much as I do. I don't understand why I've only had it for a short period of time and it's dying here. But anyway, not your problem right now. We'll make it through tonight, but the writing is going to be kind of worse than usual, which is pretty bad. So if you can't read something, just ask me, but listen to the words that I'm saying is the best way to know what to write. Okay, but prior period statements reviewed or compiled, less assurance than an audit. So what we're saying is we're going to have less assurance than an audit. And in the case of a compilation, there's no assurance. In a review, we have something called negative assurance. And we'll get more into this into A6 when we get to A6, okay? But notice we got 2022, 2021 sitting right next to each other with different levels of assurance. Well, the auditing standards want to make sure that we put some information in our report so that users don't get confused as to what year was audited, which year was receiving these lesser levels of assurance. So let's just take a look at that. When comparative financial statements are audited and presented in comparative format with prior period financial statements that were reviewed or compiled, and the report of the prior period is not reissued, again, we don't have the compilation review report sitting there so someone can look at it, then we again will include in other matters paragraph for non-issuers and explanatory paragraph for issuers. Why can't they call them the same damn thing? Why can't they just get along and use the same format so we don't have to sit here and keep calling out two different names of two different situations for the same situation? We will include in our report the level of service performed in the prior period. So we're saying, hey, 2021 in our other matters paragraph, 2021 was not audited, it was reviewed. Here was the date of the report, a description if there were modifications to that review report, a statement that the scope of service was less than an audit and does not provide the basis for expressing an opinion. That's a big deal. And then a statement that no opinion or other form of assurance expressed on the financial statements in the case of a compilation, because a compilation has no assurance. Okay, so it is important, I mean, all of those, flashcard, all of those, but that fourth one is one that I can really see the examiner is expecting you to know in a multiple choice question, because it's important that users understand that the assurance, or in the case of a compilation, no assurance that was given in that previous year is less in scope than what they're seeing in the report for 2022. Okay. All right, good. Let's come over and let's take a look at, they give us an example of that paragraph, but I think we saw some of the key elements there in that flashcard. So let's just take a look and see what happens if the prior period statements were not reviewed or compiled. So now what? Now in 2022, we have an audit, and in 2021, we had nothing. Okay, no audit, no review, no compilation. Now what? If the prior period statements were not audit reviewed or compiled, the other matters paragraph, explanatory paragraph, or an issuer should indicate that the auditor did not audit, review, or compile the prior period statements. Okay, so they just want you to warn the users, hey, look, you got two different levels of service going on, or no service, no audits, no accounting services being provided in a year where we're comparing the statements. They just want you to warn the users to the level of assurance that was provided. Okay. All right, good. Let's go ahead and let's put our poll up for tonight and look at our first multiple choice question. Okay, let's go ahead and take a look at this question. And we're below the, little bit below the desired 70%, 75% correct on this one. So let's take a look at this. But we're saying that when reporting on comparative financial statements, an auditor ordinarily should change the previously issued opinion on the prior period's financial statement, and 60% of us got it right. The answer is A, prior year's statements are restated to conform with the generally accepted accounting principles. If that's the case, then you will what? You will change. Only dorks change your opinion, right? If they fix it, you change your opinion. if the auditor is a predecessor auditor who has been requested by a former client to reissue the previously issued report, well, that doesn't mean that you should change the previous. You may leave it alone, right? If everything was okay. Prior as your opinion was unmodified, and the opinion on the current financial statements is modified due to lack of consistency. That's just sheer nonsense. Some choices I can't even give you a reason why they're wrong other than saying they're just nonsense. The auditing exam is real good at putting together wrong choices that when you look at them, you're like, what does that mean? And the answer is nothing. It's just a bunch of words that they made sound like it meant something. Prior year's financial statements are restated following a change in reporting entity in the current year. I don't know what that means either. Both of those are just complete nonsense. C and D. Okay. All right. Good. Looks like I'm going to be sending out some nasty emails later tonight for people that aren't showing up to class here. So we're our second class and we already got people deciding that they don't need to come. Okay. All right, good. Let's take a look at our next question. Okay, let's go ahead and take a look at this one. Looks like most of us had a chance to try it. And good, just about everyone got this one right. Okay, so I think we're at a good 90%. So that's good, good work. Let's take a look at this one. Comparative financial statements include the prior year statement that were audited by predecessor auditor whose report is not presented. Okay, and that's why I kind of wrote in there, they should probably use the words in parentheses, not presented, instead of not reissued, or not instead, but they should also use the words not presented, because that's what this question is using, that terminology. If the predecessor's report was unmodified, the successor auditor should and add an emphasis, a matter that expresses only limited assurance concerning the presentation of prior year statements. No. Express an opinion on the current period statement and make no reference. No. Indicate in the other matters paragraph that the predecessor auditor expressed an unmodified opinion. We're going to summarize what happened, right, with the prior year's report. So that's why C is the correct answer. Okay. Okay, good. Let's come over. obtain a letter of representation from the predecessor auditor concerning any matters that might affect. No, that's not. No, when the other report is for D, I was just reading D there. When the other report is presented, then the predecessor asks for a letter from the successor, right? Okay, so D again. What kind of makes the auditing exam could be difficult is the way they cleverly word some of the choices to sound like some things we've talked about, but then they're somewhat off. So that's why I think the flashcards really help to cut away some of that fat, if you will, that might be around your understanding, to sharpen it so that you can quickly pick out the correct answer. Of the 4 exams, I think your time constraint is probably the least honest in the auditing exam. For financial and reg, I think you have a time squeeze, financial probably being the biggest, then regulation, then BEC, and then audit is probably the least of the exams where you're probably going to feel a real time crunch. And that is facilitated by making good flashcards. Okay. All right, good. Let's go ahead and talk about reporting on audits of group financial statements. And when we say group financial statements, we are basically talking about that is AKA consolidated. Okay, so what happens? You take a look and you have company A, you have company B, okay, and then of course you will combine company A and company B and have consolidated. Okay, and the consolidated is considered group financial statements. Company A and company B are considered components. Components of the company A and company B. Now you may say, well, why don't they just call it a consolidation? Why don't they just call it company A and company B? Because some consolidations don't deal with companies. For example, the federal government has consolidated financial statements in which they take 32 agencies and compile those and consolidate those into a set of consolidated financial statements for the federal government. But we can't call them company A and company B because they're agencies. In that case, my old office, the GAO, would be the group auditor, because it's called out in legislation that GAO audits the consolidated statements. And then other auditors called component auditors and you can have component auditor 1. You could have component auditor 2. Okay, so for example, Treasury is one of the big parts of the consolidation, but the Treasury part of the audit is done by the Treasury Inspector General, and then GAO directs the efforts of the Treasury Controller General because they are the group auditor. Okay, so just giving you a visual here of what it is that we're doing. So a component is a component of a business entity or business activity that prepares financial information that is included in the group financial statements, right? It's like a consolidation. You have the component auditor, is the auditor who performs work on the financial information of a component. Partner is the principal auditor, okay? And then the group engagement team includes the group engagement partner and other partners and staff who establish the overall audit strategy, communication, etc. And then, of course, you have the group financial statements, which are essentially the consolidated financial statements. Okay. All right, good. So just give you a sense of some of that terminology with that little drawing there. But let's just go ahead and let's understand what the group auditor has to do as they direct the work of the component auditor. So the group engagement team must understand the following for each component auditor. There could be one, there could be two, there could be several, depending on the size of the entity and the number of components, right? So let's just go ahead and flashcard. The group engagement team needs to understand whether the component auditor is independent, what is their competence, the extent to which the group engagement team will be involved in the work of the component auditor. We're not going to be able to just take their report, close our eyes and take their report. We're going to have to do some level of work to be satisfied that we can rely on their report. Whether the group engagement team will be able to get information needed for the consolidation process, and whether the component auditor operates in some sort of regulatory environment. Okay, so go ahead and flashcard what the component auditor has to understand about the what the group auditor has to understand about the component auditors. Okay, now determine whether to make reference. Let's take a look. The auditor should use the understanding of each component auditor to determine whether to make reference to the component auditor in the report. So we're either going to make reference to them or not make reference to them. Okay, so you can see that those are the two options. Option one is make reference. Option two, coming over to the next page, is make reference. Okay, so we're either not going to make reference or we will make reference. That's our choices. Okay, now let's just go back up. When the group engagement team relies on the component auditor to perform a portion of the audit, we have the choice. Oh, there it is. I thought there was somewhere they laid out the two, and then I ended up going down. We're either going to not make reference or make reference. There it is. Okay. All right. So let's just take a look. Option one, make no reference. Now, you know, they say based on your understanding, there could be a lot of reasons why you would decide to not make reference. In the case of the GAO, even though there are other auditors auditing components of the federal government, agency of the federal government, the GAO does not mention those other auditors. And when you read that report, it is as though they are not even there. Okay, and there's not only, you know, some matters related to how you've obtained the understanding about them. Maybe you just don't want to refer to them. You know, it's going to mess up your report too much, and you want your report to be a little cleaner than that. So it's really a professional judgment that's made by the group auditor. Now, if you make no reference when the group auditor engagement decides to assume responsibility for the work of the component auditor, no reference to the component auditor should be made in the auditor's report. Okay, so flashcard that. No reference should be made. And when the group auditor is assuming responsibility for the work of component auditors, the group team should determine the type of work performed of the various components. So why don't you know what? I'll save you that flashcard because that's obvious. If you don't make reference, then you're assuming responsibility and you're not going to mention them. Go with the second paragraph here. You're going to, and you can add to that paragraph, you direct their work. You tell them what to do because you're going to ultimately take responsibility for their work. So it's like they're your staff. Okay. Now, how will you basically look at that work that they've done? Because if you're directing their work, you're going to have to basically review their work, and your review of their work will, vary by component, and it has to deal with significance due to individual financial significance. And I just want you to put that is equivalent to materiality. So if materiality. So essentially, if you have a very large component, you're going to be involved more in that work, reviewing it, seeing that they did a good job on that work because the numbers are big, okay? And so that should be audited by the group engagement team or the component auditor, and then you're going to get heavily involved in basically reviewing the work of the component auditor. So the group auditor is not prohibited from auditing a piece directly. That's the case in the GAO. The GAO, it's written in legislation, audits the IRS because it's the heavy hitter on the income statement of the federal government, and the GAO audits the Bureau of Public Debt directly because they're the heavy hitter on the balance sheet. Okay, so the group auditor could audit pieces, components, but then they're going to be responsible for carefully reviewing the work of the component auditor based on financial statement significance, which really is a materiality consideration. So the bigger the entity, the more likely the component auditor is going to, the group auditor is going to be more involved. Significance due to risk of material misstatement. And so that's now related to risk. So you could have what? You could have a smaller component, but if there's a chance that it's going to cause a material misstatement for some reason, because it's particularly significant, or maybe it's a controversial component or something, I don't know, then the component auditor is likely to include significant risk to material misstatement. The group engagement team or component auditor should perform an audit on the financial information. In other words, they're going to go through, do a good deal of work on that, and you're going to direct and review their work. Okay, so just flashcard, you know, significance due to financial significance and risk. Okay, now components that are not significant, either because they're not risky or they're not material, then the group engagement team can perform analytical procedures for components that are not significant. In other words, you're not going to do a lot of detailed testing. Here, you will do audit tests. Let's just put the word detailed up here. Somebody's going to do those. And if the component auditor does it, the group auditor is going to come behind with a fine-tooth comb and make sure they're satisfied that they did their work properly. Now, if you decide to make reference, now we're going to basically indicate a division of responsibility in the report. So if you make reference, okay, and let's go ahead and just flashcard what to do when you make reference. When you make reference, the component auditor the reference to the component auditor should not be made unless the following two requirements. The component auditor has performed an audit in accordance with the relevant standards, and the component auditor's report is not restricted to use. So if you're going to reference them, you have to meet these requirements. And then when making reference to the component auditor, we will see that in the auditor's, when making reference to component auditor, we'll see in the group auditor's report, it'll clearly indicate in the opinion on the financial statements. Guys, put an X through auditor's responsibility paragraph. They made a mistake, and I called them on that today, and they fortunately got back to me in time. They shouldn't have said auditor's responsibility paragraph because there is no reference to the other auditors in the auditor's responsibility paragraph. It seems like there should be, but they did not. So it's in the opinion paragraph for the non-issuer. So put the word opinion up there. That's his opinion. And then for the issuer, we will make reference in the opinion paragraph and the basis for opinion paragraph in flashcard where you will make reference. Okay. And so let's just go ahead. I think it's worth to look at that report just to, I'm going to come back to that 2.33 in a second, but just to clarify why I had you cross out for the non-issuer. Okay, notice that it's in the opinion paragraph where we start saying, hey, look, other auditors audit pieces, and you literally call out the percent of revenue or something that was audited by those other auditors. That's what we mean by making reference. And notice it's in the opinion paragraph. When you get to the auditor's responsibility paragraph, it's the same as you've already memorized for the standard report. So it used to be that you would mention an auditor's responsibility. That changed, and they put the correct new report in there. But you know, you can imagine there's going to be a errata like that in a textbook from time to time. So they're going to clean that up for an errata. Thanks to sometimes I think they said, oh God, here comes a new mail from Lord. Now we're going to have to change something in the book. But they were gracious and said, yeah, we messed up. We'll fix that. Okay. Now, let's look at the public company report for a second. Okay, the issuer report, and notice the book was correct there the way they showed that. That's in the opinion paragraph, right? And they talk about the percentages. And then when they get to the basis for opinion, we say, we believe that our audit and the reports of the other auditors. So they do mention it in 2 paragraphs as the book indicated for issuers. For non-issuers, it's just in the opinion paragraph. Okay, now let's go back. And what happens if there's a modification for a component? Okay, if the opinion of the component auditor is modified or the report group financial statements, and when appropriate, can you hear me? Okay, there we go. Some message that my internet was not stable. And when appropriate, the group auditor should modify the opinion. And this does happen, guys. In fact, if you read the GAO's disclaimer on the financial statements of the consolidated federal government, one of the reasons they call out is because there's a disclaimer on Department of Defense. And Department of Defense is such a significant component, a material and significant component, both from materiality and risk standpoint, that bubbles up into disclaimer on the consolidated statements. And that does happen. Okay. Okay, good. All right, so let's just go ahead then with all that, and let's take a look at our next question. Okay, good, guys. Looks like everyone's had a chance to take a shot at this one. So let's take a look. And okay, we're getting close to 70%, but not quite. Okay, so hopefully we'll start to improve as the evening goes on. But let's take a look at some of the choices here. And so the correct answer is D, but let's take a look. A group auditor decides not to refer to the component auditor who audited a subsidiary of a group's auditor's clients. In this situation, the group auditor most likely would add an emphasis of matter paragraph. No, it only affected what? It only affected the opinion paragraph in the case of non-issuer, and the opinion paragraph and the basis for opinion paragraph if it was an issuer. And let's see, do they tell us who we're talking about here? Issuer, non-issuer, doesn't say. Okay. Document in the engagement letter that the group auditor assumes no responsibility for the component auditor's work. If we don't mention them, we are absolutely assuming responsibility for their work. That's nonsense. C, obtain a written permission from the component auditor to omit reference. Okay, no, we didn't have any kind of discussion about that. Guys, make sure you're paying attention. Okay, I'm not quite sure how we didn't get 100% on this one, because the clear right answer is what? Determine the type of work to be performed by the group auditor on the financial information of the component. Yeah, when we don't refer to them, we're going to direct their work. Okay, that's a pretty easy question, guys. We should have been up around 90% on that. Is there something I'm missing? Okay. Okay, make sure you're paying attention, guys. Don't just be kind of working on other stuff and then choosing the answers just to not piss me off. Okay. All right, let's go ahead and let's take a look at module 9 now, subsequent events. Okay, and let's take a look at, let's talk first about what a subsequent event is. So what happens? I do my audit work. Okay, and I think I am ready to issue my report. But what happens is stuff keeps going on between the end of the year and the date of my report, because the date of the financial statements is 12/31. The date of my report might be, I don't know, February 14th or something, just to pick a friendly date. Okay, so what happens? I have to remain vigilant for things that might happen between the end of the year and the date of my report. Those are called subsequent events. And those subsequent events may either have to be recognized in the financial statements, meaning that there will be what? There will be a journal entry associated with that event, or they will be considered non-recognized. Non-recognized means that there's no journal entries associated with those, but they must be, that says must be disclosed. So must be disclosed. Recognized subsequent events are recorded and disclosed. By that meaning there'll be a footnote that'll talk about the subsequent event and how it's recorded in the financial statements. Okay, so let's look at those two. Let's look at the recognized subsequent events. And when there is a recognized subsequent event, that means that that information about that existed at the balance sheet date. Entities must recognize the effect of all recognized subsequent events in the financial statements. For example, settlement of a litigation that arose before the balance sheet date. So what happens? There was a suit. The suit was filed in, I don't know, October or whatever, and the case hasn't been settled yet by December 31st, but then the case gets settled before we issue the financial statements, and there's some sort of loss and liability associated with that settlement. We literally would have to debit loss and credit the liability because that lawsuit existed at the balance sheet date. And it came to fruition before we issued the financial statements. That needs to be recognized. Loss on an uncollectible receivable. Okay, now that one is important because what happens? Let's say we come to the end of the year and we find out that a customer filed bankruptcy in, let's start with the more obvious case first. They filed bankruptcy in November. Well, we're going to have to write off that receivable, right? We'll have to debit the allowance. We'll have to credit the account receivable. We may then need to debit the bad debt expense and credit the allowance. That's pretty obvious because we've taken some out of the allowance if we've had to have a big write-off, okay? But let's go a little bit further. Let's say that the bankruptcy happens in February, in January, but before we've issued the financial statements. So we haven't issued the financial statements yet. The bankruptcy gets declared in January after the year end. Should that be recognized? And the accounting and auditing standards say yes, because you don't bankrupt overnight. The seeds of the bankruptcy were in place at the balance sheet date. Okay, so be careful with that because that does get a little bit tricky, and that you'd say, oh, well, the circumstance didn't exist at the balance sheet date, but the standards say, yeah, they did, even if they file for bankruptcy early in the next year, that is still considered a recognized subsequent event. Okay, all right, good. Now we come down and let's take a look at subsequent events that are non-recognized, and they provide information about conditions that occurred after the balance sheet but did not exist at the balance sheet date. Entities should not recognize non-recognized subsequent events, you think? Okay, but I think it helps to put right here, but disclose. You still got to disclose, okay? And so go ahead and flashcard that definition. I think I should have told you flashcard that definition of the recognized subsequent event, okay? And you could probably go ahead on the flashcard and just quickly at a high level put those examples there on that flashcard. Okay, so now what happens? What's an example, something like this? Let's say right here, loss of plant or inventory due to fire or natural disaster or something, right? So what happens? December 31st, a building is there. A fire happens January 15th, the building is gone. How do you handle that? Well, you'd still, in your property, plant, and equipment, include that building in there. You wouldn't have to make an adjustment and record a loss for that, but you would have to disclose, hey, you know, up that property, plant, and equipment account, well, it's about $10 million less because of some sort of fire or disaster that blew that plant up, okay? Now, what happens? Subsequent event, guys, is scary for auditors, okay? Because you don't, you know, the world is happening out there, you know, news, you know why they call it news, north, east, west, and south means stuff is happening all over the place, okay? And so, you know, it's a little bit hard to get a handle on all these particular things. So we have to keep our eyes opened, okay, for some time. And for public companies and other entities that intended to widely distribute the financial statements, we must evaluate subsequent events through the date the financial statements are issued. So you have to remain vigilant for these recognized and non-recognized subsequent events through the date the financial statements are issued, okay? Coming down, financial statements, where they tell us for all other entities, here it is. For all other entities, we must evaluate subsequent events through the date the financial statements are available to be issued. Flashcard that. They give you a definition of available to be issued. Guys, I'm not gonna babble on about what that means. Just know that for public companies, it's through the date they're issued, and for non-public, it's through the date they are available to be issued, okay? Now, if you reissue financial statements, okay, because you've discovered something and you've made a change, that might trigger the thought, well, now I have to look for any other kind of subsequent event that might have happened from the original date of my report all the way through to my revised, reissued date of the report. And that is not the case, okay? You do not have to continue to look for those sort of subsequent events. Okay, and again, subsequent event disclosures, okay, and non-recognized subsequent events should be disclosed, and then there's still disclosure for what? For recognized. So disclose, 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 right? Okay, good. So how are we going to get a handle on these subsequent events? And the auditor, and again, I do like this mnemonic that you need to flashcard, will do a prime review. And you're looking around and you're seeing, hey, has any stuff happened that needs to be disclosed or recognized from the end of the year to the date of my report? Okay. And so let's look at those post balance sheet transactions. You'll look at transactions that happen in that next year and see if they actually indicated some sort of subsequent event that need to be booked or disclosed. Representation letter. We're going to talk about the representation letter more towards the end of the class here, but we keep talking about it throughout. So let me just make sure we understand what a representation letter. I don't have the formal lecture until later. So with the rep letter, it comes at the end of the audit. And we have a management rep letter. And in that management rep letter, management puts down information about things that are hard to audit. For example, we make them tell us that they've given us complete information. We make them tell us about subsequent events. We make them tell us about any fraud that has occurred, because these things are difficult to audit. So we cover ourselves by making them put in a management letter things that are hard to audit. The date of the management rep letter is the same date as our report. And then it is signed by the CEO, CFO, whatever. And we put them on the hook for hard to audit things. Okay, and subsequent event is one of those. And we'll talk more about the nature of things in the rep letter in a different class, towards the end of this class. But we keep referring to it in certain circumstances when the rep letter needs to include something. So I just wanted to give you a sense of what that letter is all about. It comes at the end of the engagement. Okay, inquire. We're going to ask them, hey, tell us about things that have happened. In fact, make sure you put those things in the management rep letter. We'll have that conversation. We can look to the minutes of stockholders meetings. I was on an engagement one time where we were looking to see, well, I think that was, I want to say that was the, I forget, I think it was the House of Representatives Child Care Center. I was doing a financial statement audit on that one. And all of a sudden in the board minutes, they started talking about the lawsuit, the suit. And I was like, what are they talking about? The suit that somebody wore to work? What suit are they talking about? And so once I saw that, I was found out that there had been an employee that was upset with the company, with the child care center, and was actually, going to be taking them to court. Well, that needed to be disclosed, but it wasn't in there because they didn't know how to prepare a set of financial statements. It wasn't being disclosed unless I told them to disclose it, which they finally went ahead and did. So that's the kind of thing you'd be looking for. And then you could examine the latest interim statements, because interim statements don't have as much scrutiny as the audited financial statements do by external auditors. So there's a chance they could already be preparing the interim statements and whatnot while you're finishing up the audit from the previous year. And you might start to see things that are disclosed in the interim statements that maybe perhaps need to be disclosed in the year-end statements. Okay. Okay, good. So make sure you have that flashcard on crime. I don't think we need to get to that report. I think it's pretty clear to us, what we mean by subsequent events. Okay. Okay, good. Yeah, let's go ahead and take a break right now, and we'll come back and we'll pick up and talk about auditor's responsibility after the original date of the audit report. Okay, so we'll pick up with number 4 here when we come back. So I'm going to reconvene us at 6:30. That'll give us a little over 10 minutes for a break, and then we'll pick up here. Okay, and I'll pause the recording. Somebody please make sure I start it up again. Okay, good. So let's go ahead and jump back in here and take a look at really some of these things are very unusual to happen, maybe sort of a special case. And so I don't think the examiners are really going to ask you this, but let's just put at least one flashcard on some of this stuff up here to make sure that if we do get a question on that multiple choice question, we've got some coverage on it. So let's just take a look. And they tell us the auditor has no active responsibility to make inquiries, to perform any further audit procedures, to discover subsequent events after the original date of the auditor's report, except as described in the chart below. So let's just look at that chart and let's flashcard those situations, okay? And be done with that. Just go ahead, you can make a screenshot of that, put that on a flashcard, and that's all I want to do with that. Okay, now you come over and you take a look. However, if an auditor becomes aware of any information relating to subsequent event before the report release date, the auditor should consider what is necessary to adjust the financial statements or the related disclosure. And we know that already. That's what we've been talking about with subsequent event. So let's just take a look here. The auditor should extend subsequent event period beyond the audit report date for the situations identified below. So really that first paragraph is useless. I don't know why I looked at that. Note to self, don't read that paragraph anymore because we're wasting time on it. Okay, so I just want you to flashcard those couple situations. Okay, now if you have something that materially affects the report, okay, so let's just take a look. If information that materially affects the report and other person's reliance on is discovered after the issuance of the report. So this gets a little confusing. You're like, well, I thought my responsibility ended. Yeah, but you can't be, putting blinders on and saying, okay, I'm not aware of anything else that could have affected my report. So even though it's after the report is issued, if something comes up and hits you in the face that should have been disclosed, then there's an expectation that you do something, okay? And so you should advise those that may be relying on the financial statements what they're saying to us, you should do the following procedures. And first is to tell the client to reissue the financial statements, advise the client to make the necessary disclosures. If the effect on the financial statements cannot be determined on a timely basis, provide notification that the financial statement should not be relied upon. In addition, the client should be advised to discuss with the SEC, the stock exchanges, etc. Okay, so again, you aren't responsible to search for these things, but if things after the issuance of the report come to your attention, then you do have certain responsibilities. Now, those are the procedures that are supposed to happen, but what I want you to do, because they get a little confusing here, I'm going over to the next page now. Okay, so draw an arrow coming off of your page here and then up to the next page, I have to scroll down and then just point to client refusal, because really what they're talking about is a client refusal to follow those procedures that we saw on the previous page. So you have this statement here of what the auditor is supposed to do, advising the client, asking them to make the disclosures, etc. Notice it's all asking the client to discuss with the SEC. It's the client, right? And then you come over and you point here. If the client refuses to follow the procedures, and they say above, but that's where the arrow is pointing to. If the client refuses, the auditor should notify each member of the board of directors of such refusal. Now, that's the first thing you do. This is a prayer, okay? Notify each member of the board of directors, and you're praying that the governance system works. Hey, they're supposed to do this, they haven't done that. After you do that, then you will, if the board of directors says, hey, don't worry about it, okay, forget about it, right? Well, now you're going to have to go, and you're going to have to go beyond just notifying the board members. And so I'm going to make that steps 2, 3, and 4. They put these 4 bullets, these 3 bullets here, but there is a first step that was up in the paragraph. So notify the client that the auditor must no longer be associated with the financial statements, notify applicable regulatory, and notify persons that may be relying on the financial statements. Hey, we asked the client to do something, they refused, okay, of this thing that's come up and hit us in the face after our initial report. We're not too happy, we're none too happy. We're talking to them, hey, you gotta reissue the statements and that. They say, here. We go to the board of directors and say, oh, don't worry about it, right? Now we have to start talking outside of the company, right? And that's steps 2, 3, and 4, and you should flashcard those. Okay. Now up here, if they follow the procedure and they're doing what we want them to do, or for whatever reason, there's a disclosure that's added to the financial statements either after we've issued and we're reissuing, or before we've even issued them, you can go ahead and you can do something called dual date. If adjustments are disclosed after the date of the original report, the auditor may dual date the report to extend responsibility for the particular subsequent event. The original date of the report is maintained. So, let's say we were going to issue the financial statements on February 3rd, okay? Let's say the date of our report is January 21st. Let's say, what today? Oh, today is January what? Let's say today they sit there and they, call me up on whatever today is, which I can't see. Anybody want to give me the date today? The 27th, okay?
At 27.
So let's say they call me today, the 27th, and they say, hey, look, we want to issue the financial statements on February 3rd, but, we had a problem. We just had a plant blow up today, January 27th, and we need to disclose that. So I go in and I see that they are disclosed, look at the disclosure about the plant blowing up, and I erase January 21st and I put down January 27th. If I do that, not only am I taking responsibility for that one new disclosure, but any other subsequent events that might have happened between, January 21st and the 27th. And, so I tell management, well, I got to do another prime review. They say, we don't have time for all that. We want to issue statements next week, whatever. Then we would say, okay, we'll dual date the report. We'll say the date of our report is January 21st, except as it relates to this one footnote about the plant blowing up, the date of our report is February 3rd. That's an example of dual dating. And for whatever reason, you going to change the date on the report, either before it was issued or after it was issued, you want a dual date so you cover yourself for any subsequent events. Okay, good. Come over and let's take a look at the question. Okay, looks like most of us have had a chance to go through this one, so let's just take a look. And okay, still falling below the 75%, but pretty decent outcome. Looks like some folks liked choice C here as well, but choice A is the correct answer. So let's just go ahead and take a look at this question, and I'll try to understand why maybe C was tempting for some of us. So on August 13th, a CPA had obtained sufficient appropriate audit evidence with respect to field work on an engagement to audit financial statements for the year ended June 30th. On August 27th, an event came to the CPA's attention that should be disclosed in the notes of the financial statement. The event was properly disclosed by the entity, but the CPA decided not to dual date the audit report. Not to dual date the auditor's report, and dated the report August 27th. So they erased the old date, which was what, August 13th, I guess, and put in the 27th. Under these circumstances, the CPA has taken responsibility for all subsequent events that occurred through August 27th, choice A. What they should have done was dual dated the report. They should have said, what, August 13th, except as it relates to this one thing, of which the date is August 27th. All subsequent events that occurred through August 13th, and the specific subsequent event disclosed C. Now I see why some of you pick C, because that's what they should have done, but that's not what the question described that they did, right? Okay. Okay, good. Let's go ahead and let's take a look at other information and supplementary information. Okay, so what are we talking about here? Well, let's say we have our financial statements. FS, financial statements, is how we abbreviate financial statements in this class. And of course, the auditor's opinion, we know, covers those financial statements, right? But then sometimes GAAP comes in and says, well, we're going to require supplementary information. That says supplementary information. Sorry, guys, I can't make it any less than that because the tip of the pen has gone flabby on me here. So it's bending and not letting me write properly. So we have supplementary information, and then sometimes that whole package, the supplementary information, could go into some sort of annual report. Okay, so when you look at this, and I kind of wrote over it, so I apologize, but frequently audited financial statements are incorporated into other documents such as annual reports. So the question starts to come up, well, what is the auditor's responsibility for? We're understanding the auditor's responsibility is to give an opinion on the financial statements, but does that responsibility extend to the supplementary information, the annual report? And so we're going to start to understand here now how the auditor's responsibility is, and what I've noted is it has started to increase here in the newer version of the book. I'm noticing now that the responsibility for the auditor is increasing as it relates to this. The primary responsibility for the auditor, though, is the financial statements. Okay, so let's go through and let's see what the auditor's responsibility are for some of these other things. And so we come down and notice that other information does not include press releases and that kind of thing, but just come over auditor responsibility. Through discussion with management, the auditor must determine and obtain written acknowledgement regarding the documents, regarding which documents make up the annual report. Okay, so you're going to have discussion and get written acknowledgement regarding which documents make up the annual report. So you can flashcard that. But then they tell us here, generally, the auditor's is not responsible for determining whether other information and documents containing the audited financial statements and the auditor's report is properly stated. So they're really talking about the annual report there, right? Because that contains the financial statements and the supplementary information. However, I'm going to ask you to flashcard this. The auditor should read the other information because the credibility of the audited financial statements may be undermined if there's a material inconsistency between the financial statements and the other information. And the auditor must consider any material inconsistencies between the other information, the financial statements, and take the appropriate action. Okay, respond accordingly. We're going to talk about some of those responses in a minute. That. Now, what are we talking about here? Well, let's say the financial statements show that the company had, losses over the last 3 years, and then we look in the annual report and there's some sort of chart showing, income going up over the last 3 years. Well, no, that's a material inconsistency, right? And so what will we do in that situation? Okay, the material containing the audited financial statements may contain other information as material. There's material inconsistent. If the auditor identifies a material inconsistency, the auditor should determine whether the audited financial statements or the other information needs to be revised. Maybe the statements are wrong and it's the other information that's correct. Okay, then you come down, and if the audited financial statements are the thing that had the problem, then of course we will go ahead and ask them to fix it or modify the audit opinion because there's something wrong with the financial statements, right? But what if it turns out, no, the financial statements are fine. It's the other information that requires revision. What should we do there? And that's where I'm going to ask you to put the flashcard here. If the other information requires revision, okay, because of a material inconsistency, we should communicate the matter to those charged with governance and consider the implication on the auditor report, withhold use of the audit report, or withdraw from the engagement. Okay, so we're going to really, not directly so much they're saying, but really we're going to ask them to fix that, right? And if they won't fix it, we're probably not going to let them use our report, and we're going to end up withdrawing. I can't really imagine a situation where management's going to, have something that's really ghastly wrong in the annual report and refuse to fix it, right? But it is an exam, and they like to consider all possible weird things, and so you might get one question on that. So I want you to put a flashcard on how to respond to that. Okay. Now, when you come down, we could be allowed to actually provide an opinion to report on other information. Now, that's not, and we'll talk about that in a minute here, but what this is what we need to do when there is that other information, okay? And for the non-issuer, the auditor should reference the other information in the audit report and the financial statements by including a separate section with the heading Other Information, and the section of the audit report should contain a reference to the other information in language clarifying the auditor's responsibility for it. So, and of course, our responsibility is we, aren't responsible for it. We read it and consider any material inconsistencies, but we're not responsible for providing assurance on it. Okay, and that'd be it. We would just talk about other information in the audit report and say that it's there, acknowledge it, and say that we read it for material inconsistencies. Okay, good. Let's come over and let's take a look at reporting on supplementary information. Okay, so that's that other box that I drew. And when we look at supplementary information, is information presented outside the basic financial statements that may be presented in a document containing the audited financial statements. For my FAR students, just think back to what we talked about when we were talking about the comprehensive annual financial report of state and local governments. And we had what? We had the financial statements, but we also had the required supplemental information, the MD&A, and then required supplemental information other than MD&A. That's what they're talking about here. And then remember, we lifted that whole thing and put it in the comprehensive annual financial report. Okay, so when entities do that, the auditor may be engaged. We don't have to, but we may be engaged to report on that supplementary information. Okay, in other words, we're going to give an opinion on that supplementary information. And we're going to evaluate the presentation of that supplementary information in relation to financial statements and to report whether the supplementary information was fairly stated. So flashcard that and make sure you make it clear that we may be engaged to do that. Okay, so we're going beyond now. We're actually extending assurances to the supplementary information. They're going to have to pay us a little more for that, but it is going to extend our responsibility. And you're going to see that one of the key things is making sure that that supplementary information ties to what we know about the financial statements, which we would have been required to audit in order to give this assurance on the supplementary information. So let's just go ahead and take a look at the conditions for reporting. In order to issue opinion on whether supplementary information is fairly stated in relation to financial statements, the auditor must determine the following 5 conditions are met. Let's flashcard those 1, 2, 3, 4, 5 here, right? Okay, they did a nice job of numbering that. The information was derived, relates directly from the financial statements. The information relates to the same period. The financial statements were audited and the auditor issued a report on those. Again, notice how much we're tying it to the audit of the financial statements. We don't have an adverse opinion or a disclaimer of opinion on the financial statements, and the supplementary information will accompany the financial statements. So we're extending our responsibility to that supplementary information, but it's all about the work we've done on the financial statements now, right? Okay, and we're going to look at some specific procedures here in a minute. Now, management, of course, is responsible to make sure they've prepared that supplementary information correctly, and they need to provide us a management rep letter regarding now not just the financial statements, but also the supplementary information. Okay, so let's just take a look at the procedures that will allow us to give the assurance on the supplementary information. And we are to conduct these procedures in addition to those that we do for the audit of the financial statements. And so we are to inquire of management regarding the purpose of the supplementary information, determine whether the form and content complies with the applicable criteria, obtain an understanding of the method used to prepare. Again, compare and reconcile to the financial statements. And that's the one that I see in the questions, guys. They want to make sure that you understand that even though you're giving an opinion on that supplementary information, it's all about whatever you have done with the financial statements. What are the underlying assumptions? Evaluate the appropriateness and completeness. I think they already said that, or I guess I said that under management's responsibility, we have to get a representation letter. Okay, subsequent events do not extend to the supplementary information. So flashcard that. Again, you don't have to give the opinion on the supplementary information, but you do need to acknowledge that it's there and that it's okay, and that it's there and that it's materially consistent. But you don't have to give an opinion on it. But if you do, then you have to follow these procedures. Does that make sense? Okay. For the supplementary information, you don't have to give an opinion on it. You have to acknowledge that it's there, say it's there, and it's materially consistent, and that you read it for material consistency, but that's not an opinion. If you want to give an opinion on that information, then you're going to have to go into these further steps here. I looked at these Pcaob requirements, and they give us a separate box for it. It's the same stuff, so I don't see that there's anything significantly different there. for public companies that I think we want to spend our time on. Okay. Okay, good. So let's take a look at presentation here for non-issuers. Okay, the supplementary information. The auditor's report on supplementary information either may be in a separate report or presented in a section of the auditor's report on the financial statements called supplementary information. Okay, so when you look, this is what sample supplementary information section, and we are basically going to give, in our opinion, the information is fairly stated. There it is. So they literally can go ahead and give that opinion because they've done that additional work, and just flashcard that it could be contained in our report on the financial statements, or it could be in a separate report, and you might want to go ahead and flashcard and make it all one flashcard. If the information is contained in a separate report, then the separate report should reference our audit on the financial statements, and if there were any modifications to our opinion, we need to call those out there. Okay. Okay, good. Let's go over, and of course, if there is a material misstatement in the supplementary information, we of course will ask them to revise it, and if they don't, we'll modify our opinion on the supplementary information. Okay, if a separate report is being issued, we withhold the report. Okay, so again, we go down the same path for material misstatement in the supplementary information as we would for the financial statements. We start qualifying our report, etc. Okay, let's just take a look and see the effect of modifications on the audit report on the financial statements. And when the audit reports on audit financial statements contain an adverse opinion or disclaimer of opinion, and the auditor has been engaged to report on supplementary information, the auditor is prohibited from expressing an opinion on the supplementary information. So when we start getting down to disclaimers and adverse opinions, right, on the financial statements, then they tell us, well, guess what? Now you can't give an opinion on the supplementary information. You can flashcard that. Okay. Okay, good. For issuers, and we're going to have the same issue, the same set of information, guys. So I would not worry about giving yourself a separate flashcard. If there's material misstatements, you're going to give it, qualification on the opinion, etc. It doesn't change. Could be in combined or separate reports. I don't see anything materially different from what they said about non-public companies that we need to give ourselves separate flashcards and whatnot for public companies. Okay.
Question. Can you just back up a little bit? Because I'm looking at my book, which is section 4.1, and I think there might be a slight difference between that and what you just said about effects of modifications to the audit report on the financial statements.
Okay.
You said that
4.1.
I got the current version of the text, but it's
Where are you asking me to look on this page?
It just go back one page from where you were. You were talking about when the auditor expresses an adverse or disclaimed opinion on the financial statements.
Yeah.
What's in my text says the auditor should also express an adverse or disclaim an opinion on the supplemental information. It doesn't say that they're prohibited. I've got different language in that last paragraph than you do.
Okay. Well, let me look at a couple of things here. What page are you on?
Well, actually, the page is a little different. It's my A1-93 and it's your A1-91. It's still, and
mine matches up if that's of any consequence.
the same.
Effects of modification on the financial statements. When the auditors report on the audit financial statements, are you sure you didn't get on the wrong page?
I'm positive I didn't get on the wrong page. And I also listened to the lecture, and he basically said that they're not prohibited, but they must give the same opinion. And that's what's in the video lecture for this thing.
Did you end up with the 4.0 book, Kathy, instead of the 4.1?
No, it says version 4.1.
I don't
They
know.
sent me
I'm-
the 4.0 initially, but then they sent me the 4.1 and I'm in the 4.1 now.
I've got 4.1 here too, and that's what I downloaded from Becker, the PDF that we're looking at.
Maybe the PDF is different from the
No,
the
and
published book.
And my book is doing the same thing, the hard copy.
Yeah, we have the same.
Does anyone have the same thing that Kathy does? No?
Then I got a
No.
messed up copy because.
Well, I don't
my
know if
page-
it's messed up. Maybe, you know.
But I mean, it was in the video lecture because I listened to the video lecture too. And I
Well,
made notes.
Garrity's on crack half the time. I mean, I don't trust anything that he says. I'm kidding.
I mean, it's not a big
Cut.
point. I don't want to drive
Delete.
I don't want to mess up our timetable here, but
No, it's fine. No, I'll tell you what, do me a favor and send me an email on that, okay? That you have a version of the book that says this, and I will forward that to Becker and we'll try to understand what the hell's going on, because the copy I have and the PDF that they make available to me to be able to do what we're doing, obviously you can see it on the screen. I thought for a minute, did I pick up the wrong version? But I don't think I did, because it says,
Kathy, is the paragraph above section 3 requires
Yes.
supplementary information? I think you're
Yes.
looking at the wrong page.
I am.
Yes, you are looking at A193. He was referring to A190.
I am. I'm
90.
sorry. I'm sorry. They looked. They both have the same title. That's what my problem is. The
right,
headings both have the same.
but you're
title.
making a good point, because I was saying there was no difference. And maybe there is, because
Well, it says they're both titled Forming an Opinion on Supplementary Information,
Yeah.
Material Misstatements.
well, yeah, because we've been doing that throughout the chapter here, because we got this stupid public versus non-public company back and forth.
Oh, that's what it is. I'm
yeah, so
sorry.
let's
It's
see,
issuers
'cause-
versus
'cause when I
non-issuers.
read through it quickly, I'm like, I don't see that there's much of a difference that I want to spend any time with, but let's see. When the auditor expresses an adverse or disclaims an opinion on the financial statements, the auditor should also express is worth noting in flashcarding as a difference for public companies, right?
Yeah, I think what happened is when I turned the page, I turned 2 pages, or I
Yeah,
didn't
that's fine.
turn the page
Well,
right.
you know, what is it? They discovered penicillin by accident or something, you know, this is, you know, one of those kinds of
So-
things that by you know, thinking we were, you know, not realizing it was a different page, whatever, we discovered that there is a difference that should probably be flashcarded, so. Okay.
All right, sorry about that. I didn't mean to chew up so much of your time,
it's a
but
happy, you know, it helped us, so don't worry about it. Don't worry about it, okay? Just forget about it. All right, sorry. Okay, so let's go ahead and let's take a look at now require, and you know, they kind of wrote the book backwards, in my opinion here, because now they say, well, here's what happens if you decide to report on supplementary information. But now they're saying, regardless if you decided to give an opinion on the supplementary information or not, you have certain responsibilities for that supplementary information all the time. To me, they should have said that first and then talked about the optional reporting on it. So let's take a look at what they say. And they say, in the absence of any separate requirement, particularly the engagement, the auditor's opinion on the financial statements does not cover the supplementary information. Okay, so now we're going back to the situation where you're not going to give an opinion on the supplementary information, but you still have to perform the following procedures: inquire of management about the methods used to prepare the supplementary information, determine that the supplementary information is consistent with management responses, and obtain a written representation regarding the supplementary information. So go ahead and flashcard that, okay? And then you can come over and reporting on supplementary information here and what you're supposed to do. And the audit report for non-issuers of financial statements should include a separate section of the auditor's report with the language explaining that the required supplemental information is included, or if the required supplemental information was omitted. Okay, so again, just like we saw for the annual report, remember that section that talked about the annual report, we're saying the same thing for the supplementary information. We're not giving an opinion, but we have to acknowledge that it's there. And, you know, or if it's not there, we need to call out, hey, it's missing. Okay, so with the supplementary information, guys, in my opinion, they wrote the book backwards. They should have said this first, right next to this discussion that we had about the annual report, because it's kind of parallel. Instead, they got themselves all twisted up and talking about the optional opinion on the supplementary information and how that works for public and non-public companies. And then they talked about what is required when an entity has to provide supplementary information. Okay. Now you come over and they again start to call out certain things about Pcaob requirements, and I'm not going to get into that because I don't see that those are significant. And so I just want to then again remind you that an opinion is permitted, and we already talked about that on supplementary information. We talked about the opinion. Okay, so I think what happens is different people write different sections of the book, and then kind of sometimes pulling that all together in a flow that makes a lot of sense. They kind of miss the mark sometimes. And so I think that's what happened there. They should have put the requirement in all engagements when we're auditing the financial statements when supplementary information is involved, which we just talked about, and then put, and you may give an opinion if you want to, it's not required, it's permitted, and here's the requirements for that kind of engagement. Okay, good. So with all that, let's just take a look at a couple multiple choice questions, or at least one anyway. Okay, guys, I'm going to go ahead and end the poll here, and let's just take a look at this one. And wow, you guys did very well on this, considering all the back and forth we had to do to get to the bottom line on this stuff, because the way they kind of disorganized the book. So 73% of us got it correct, which is great. But let's look at this question, and we can see that the answer you saw from the poll, the answer is C. But let's go ahead and take a look. Wait a minute, the answer is C? I mean, the answer is B, excuse me. The answer is B, but let's go ahead and let's take a look at this one. And in the audit of a non-issuer, what is the auditor's responsibility for supplementary information, such as disclosure of pension information that is outside the basic financial statements, but required by GASB in this case? And I think GASB is the one that gave a lot of supplementary information, and probably why they called it out in this question. But the auditors should apply substantive tests. No, we're not giving an opinion on that information. We don't have to do testing of it. The auditor should apply certain limited procedures to the supplementary information and add a separate section in the auditor's report. That's what we said, right? Apply a few limited procedures, basically making sure it's consistent with the financial statement, and then call it out in the auditor report in a separate section. The auditor's only responsibility for supplementary information to determine if such information has been omitted. No, we have to look at it for material inconsistency. If it's been omitted, we need to alert the reader of the report to that, the report on the financial statements. The auditor has no responsibility. Yes, we do. We have limited responsibilities. We're not giving an opinion on it. We do need to read it and check it for material inconsistency, though, right? And then call it out in the audit report. Good. That's a good question, actually. That sounds like something Becker wrote. Because it kind of covers all the possibilities there. So anyway, it's a good question, though. Question on that stuff? I know that gets a little convoluted. Okay, good. Let's keep going, guys. And I appreciate your patience. I really think that Becker needs to, think about ways to keeping the chapters under 100 pages here. So, but fortunately, we were able to break it up into a couple. And so I think we'll be in good shape to finish up chapter 1 tonight anyway. So let's go ahead and talk about special purpose financial statements, and then we'll talk about frameworks for other countries here in a second. Both of these areas are fairly light on the exam. And so what they're contemplating here is what happens if the auditor is engaged to give an opinion on financial statements that prepared using some other basis of accounting other than general accepted accounting principles. For example, cash basis. Okay, maybe you have a small mom and pop grocery store that you're doing an audit on. They're mostly cash business, and they don't need to be worrying about all the different accruals and whatnot that we would do under GAAP. And so we just use the cash basis. Maybe for some reason, the entity has to follow the tax basis, IRS rules to prepare their financial statements. Regulatory basis. I was on an engagement one time where Congress wanted to know if insurance company, how insurance companies were, how secure insurance companies were that were providing annuities to retirees. Because what was happening at that time in the early 90s, companies were canceling their defined benefit plan and just kicking people out of it and just handing them the insurance annuities. Meanwhile, there was some concern that the insurance companies weren't that safe and solvent, and you could get an annuity from an insurance company that then goes bankrupt, and there goes your retirement savings. So they want us to look at that. And of course, I get assigned to that assignment, and I get stuck looking at financial disclosures of insurance companies. So I have to go over to the California Department of Insurance office, which is actually just started up at that point in time. And I have to get the financial reports of different insurance companies and take a look at those. And it turns out that they're using a basis that is different than GAAP. They're using statutory accounting practices that are promulgated by the National Association of Insurance Commissioners. And there's certain, for example, assets like office furniture that they're not allowed to capitalize because they want a more conservative look of what's going on with that particular entity, right? And so when you look at those statements, there's an auditor's opinion there saying they follow the statutory accounting practices, right? And so an auditor can give an opinion on something like that. Contractual basis, maybe we contract that you're going to make your financial statements following some requirements that we two parties have agreed to. And then there's sort of a catch-all for other bases. Okay, so let's just take a look and see what some of the requirements are. And let's see, how do I want to do this? I want to go through, they put the table first for some reason, and then they start giving us information from the table in the outline, and then they keep referring to the table above. And so what I'm going to do is I'm going to go through the outline first, and then I'm going to go and I'm going to cherry pick some things from that table that I want you to flashcard. Okay, so let's just go ahead and let's take a look at differences from the standard audit report. And notice, guys, that theme was consistent from last time throughout the chapter. You memorize pretty much the standard report, know how to tweak it for these different situations, right? And so that's continuing here. And one of the first thing they tell us is when you call out the financial statements, you can't use the term balance sheet, statement of income, etc. That is what? That is left for regular GAAP financial statements, okay? So you will have to use some other title to describe the balance sheet. And look, you could say balance sheet hyphen cash basis. If you want to get wordy, say assets and liabilities arising from cash transactions, cash basis. Statement of revenue and expenses, income tax basis. You just can't call it income statement. You just can't call it balance sheet. Okay. I'm not even having flashcard. Nah, go ahead. Flashcard that you can't use those titles. Okay. Those are only applicable to statements that are intended to present financial statements in accordance with GAAP. Okay. And then you don't have to flashcard the examples. Just know you can't use the GAAP titles. Okay. Okay, good. Let's take a look at emphasis of matter. And if required, the report should include an emphasis of matter. And go ahead and put down right here, right now, only not required for regulatory basis available for general use. That says general use. Okay. Go back to my story about the insurance companies' financial reports. They're publicly available. You could, well, I don't know with COVID, but before COVID, you could walk into the Department of Insurance financial office, says, give me the filings of Allstate. And they have to give that to you, and you can take a look at it. Well, that means it's available for general use, and you don't have the emphasis of matter paragraph in that case. In all the other cases, you must have an emphasis of matter paragraph, okay? And flashcard here, what goes into that emphasis of matter paragraph, indicate that the financial statements are prepared in accordance with the applicable framework, refer to the note that describes the framework, state that the special purpose framework is a basis of accounting other than GAAP, and state that the financial statements may not be suitable for any purpose other than the stated purpose when the purpose is required to be described. So flashcard that. Okay. Okay, good. Now you come over and they tell us their other matters paragraph, and they say if required, the other matters paragraph should include the auditor's report should include another matters paragraph that restricts the use of the auditor's report to those within the entity. And let's just go ahead, and again, I'm going to have you go ahead and flashcard that, okay? But I'm gonna have you flashcard the instances because they say if required, and it is required for contractual basis and regulatory basis when not for general use. Now let's think through that. The other matters paragraph that does what? That restricts the use of the report, okay, is required for contractual basis and regular basis when not for general use, okay? Now, let's think about contractual basis first. If it's contractual basis, it's a contract between two parties. So obviously we need to restrict that report to those parties because they're the ones that understand the contract. Okay, so we were going to restrict the use of that report between those parties that negotiated and agreed to how that information was, financial statements are going to be presented. Regulatory basis, they're saying, look, if you have to file financial statements for a regulatory basis and you're making them available for general use, they're obviously not restricted. In all other instances, if it's for regulatory basis and the reports are not available for general use, then they're restricted. Okay. Question on that? Okay, good. Come over and auditors report by law or regulation. Okay, and sometimes what will happen is the regulation will say, auditor, this is what you have to put in your report. Okay, now let's take a look. If the prescribed specific layout, form, or wording of the auditor's report is not acceptable or would cause the auditor to make a statement that the auditor has no basis to make, the auditor should reword this prescribed form or attach an appropriately separate worded report. In other words, if a regulatory requirement says this is how you write the report and it's not adhering to our standards, we say here, we're going to reword the report to match what we have to do, what we know we have to do. I had to memorize that damn report to pass the CPA exam. I'm going to write that report the way I'm supposed to. Now, that doesn't mean I went, just kind of joking when I said, well, here, you know, what you would do if you can't reword it, then to have two reports, one following the regulatory requirements and one following the requirements that we're talking about here in class. Okay. Okay, good. Come over and they show us a bunch of those reports. We don't need to read through those, but I want to go back to that table and I want to glean out a couple of things from that table that I think is a little bit helpful. Okay, and so let's do this first one here. This is an easy flashcard right here as to description of the purpose. Okay, and notice we have to we only have to include I should say just flashcard the instances in which we do and do not have to just put a description of the purpose. You just got to flashcard that, okay, in case you get a stupid question on that. Okay, then I want you to go ahead and take a look here, emphasis of matter, and notice that the emphasis of matter is what? Emphasis of matter is required in all cases except what? Except the regulatory basis right here. Sorry guys, the regulatory basis for general use. That was the one instance, and I kind of wrote that in the margin, where you don't have to have the emphasis of matter. All the other times you do, right? I'm just trying to use this table to pick up some efficient flashcards for us that might help us with some of this. And then the last flashcard here is notice that the restricting, the other matters restricting is only required, and I wrote that in the margin there, for the contractual basis, right? And the regulatory basis when it's not for general use. That's the only time that you have to include that other matters paragraph. So you can write yourself a flashcard that says, what are the only times that you don't, that you do have to restrict the report, and the only times that you don't have to restrict the report are what? Contractual basis, regulatory basis, not for general use. So you can write the flashcard, when is the emphasis of a matter not required? Regulatory basis, general use. And then when is the description? That's sort of a mishmash. And so, you want to make that whole column a flashcard, or that whole row, I should say, flashcard. Okay. Question? Okay, good. Come over then and let's take a look. And again, I don't think we need to read through those reports. We picked up some of the key elements. You might get one or two multiple choice questions on that. I think if you watch Garrity, Kathy, does Garrity tell you to memorize every report? Does he still say that?
No,
No, okay, good. Probably somebody.
he just says to look at the chart.
Probably somebody finally slipped across to him that that was a ridiculous statement. He used to say memorize every report. And who the hell's going to do that? Memorize the standard report, know how to tweak it accordingly as we've been flashcarding. Okay, good. Let's go ahead and let's take a look. It's still Garrity though, huh? It's not Tim Brown. I mean, Tim Brown. Tim Brown was a Hall of Fame wide receiver that played for the Oakland Raiders. It's
Garrity.
It's not Mike Brown.
No, it's still Garrity.
I think Mike Brown will take over at some point. Now, if Tim Brown started teaching the classes, then I would go ahead and watch him.
I was doing it largely because it was another opportunity to review the material. That was the only reason I was watching it.
Well, I'm jealous. No, I'm just kidding. I guess I get annoyed with those guys because, they get all the glorious Becker instructors. Meanwhile, I'm of the opinion that they spend a lot of time saying, highlight this, circle that. But anyway. I think there's a phrase for that, which is get over it. John.
I do think they're a little heavy on the mnemonics. Yeah, you know what I'm talking
It's
about.
a word
Yeah.
that starts with an M that you put the N. Mnemonics. It has an M, but you don't pronounce the N. The M.
Yeah.
You pronounce the N. Mnemonics. Yeah. I tried creating mnemonics, and it was a waste of time for the most part. I think I have a couple in here, but that I came up with. But okay, guys, I'm going to go ahead, and it doesn't look like many of us attempted this question, but or all of us attempted it. But let's just go ahead and see that the folks that did get it right. We had a couple of votes for C and D. So let's just go ahead and take a look here. And an audit report on financial statements prepared on the cash receipts and disbursements basis of accounting should include all the following except, and I had to make a flashcard of what gets included, A reference to the note that describes the cash basis, yes. A statement that the auditor is responsible for determining the cash receipts and disbursement basis is an acceptable basis for the preparation of financial statements. How could that be our responsibility? I mean, if they're engaging us to prepare the financial statements on the cash basis, well, that must be that it suits their purposes. They're not going to get listed on the stock exchange doing that, but they're entitled, if a bank has said, hey, prepare on the cash basis, they're entitled to prepare their financial statements on the cash basis and ask us to give an opinion on it. We will give an opinion that it is fairly stated following the cash basis, and a statement that the audit was conducted in accordance with the auditing standards. Yeah, we follow the same auditing standards, guys, the same procedures, other than the changes to the report, but the same procedures that we would do to get the evidence to support the opinion are the same, whether you're using cash basis or accrual, full accrual, or whatever basis, tax, whatever. Okay. Okay, good. Let's finish up with this other area that I think is, you know, highly unlikely that you're going to see anything on this, but we'll make a couple of flashcards out of it. It looks like we'll actually get out a little bit early, so that's good. Okay, so let's take a look. And when financial statements are prepared by principals, and the financial statements are intended to be used outside of the United States, okay, let's take a look at how we have to modify our report for distribution outside of the United States, okay? And they give us two options. One option, okay, is to follow the international standards requirements, and what they tell us, and you can flashcard that, is the report may be would be issued by the auditors in the other country in similar circumstances. The auditor has obtained the appropriate evidence, and the auditor has complied with the reporting standards of that country. And so we would do that. The options here for us, okay, we can use a U.S. form of the report that have been prepared in accordance with the financial reporting in another country, include all the elements of the U.S. report, and a statement that refers to the note. So you can either use the reporting requirements of the other country, or you can use the U.S. form report, and then you're going to make the have the emphasis of matter that calls out that they're using another reporting format, et cetera, and just use the U.S. form of the report. Those are your options, 1 and 2. Okay. Now you come over and they tell us, well, what if the report that's following the standards of another country are going to be distributed in the United States? Well, now they're going to tell us, hey, you have to use the U.S. form of the report with the emphasis of matter that identifies the framework, refers to the note that describes the framework, and indicate that the framework differs from the accounting principles that are established in the U.S. And you can just flashcard that. So we kind of go back to a similar model that we're talking about if they're using, say, the cash basis. Identify it, refer to the note, and then you have to put this statement in there, hey, this is not U.S. GAAP. Okay. Okay. Questions? Okay, guys, I don't think there are any more class questions on for this stuff. I don't think so. I guess we are done. Do me a favor. I'm not going to keep going on and on with some of these other things. They start to get a little granular down here. So that's good for tonight. I appreciate your patience as we've gone through all that. And we will pick up chapter 2 next Thursday. Any questions?
You have one question, but it refers back to FAR. So if anybody else has any questions regarding this class, go ahead first. No? then I'll ask my question.
Professor, I just have a question for the guest speaker, because we done this on the last class, the same one. Is it okay to?
Yeah, you can turn in the same one. I could look around for some recordings of some other ones if you want, if you really want to do a different one. But if you submitted it last time, I don't have a problem if you submit the same one.
Okay, thank you.
So if you're really desperate to do a different one, I can look around. I probably have some recordings of some other guest speakers.
No
I'm sorry.
problem. Thank you so much.
Yeah. Okay, well, if I'm going to I'm going to stop the recording, Autumn, and then anyone, unless your question is of a personal nature, folks can stay on if they want to hear it, but I'm going to stop the recording since it's not relevant to audit.